Hello, hello, and welcome to Lunch and Learn Live with Lynn. How's everyone doing today? I am looking forward to talking to you about life insurance because guess what? Only 52% of Americans have a life insurance. And one quick second, I'm going to shut off this bright light. Yeah, maybe I'm going to turn it back on. Anyway, trying to adjust here with my glasses. It's showing a reflection, which is a little annoying. But anyway, I think I need my glasses to read. But anyway, welcome to Lunch and Learn Live. And we're going to be talking, as I just mentioned, about life insurance. So if you're just joining me, welcome. And September is Life Insurance Awareness a month. It's so important that people understand the role that life insurance plays in their financial picture, in their picture of protecting their family, because so many people pass away with life without the proper life insurance coverages. My 40-year-old nephew passed away a couple years ago, 4 kids, no life insurance. It was an accident. So, yeah, it was very unexpected. And unfortunately, he didn't have the coverage. A couple friends of mine lost their husbands, and their husbands were, I don't know, 58, 59. And again, no life insurance. So, yeah, this happens, and it happens more frequently than it should. So, I always say to people, if you want to leave people with some protection, if someone's depending upon you for income, then it's important to have life insurance. And I'm going to go over the various types of life insurance and how it applies to us as we are preparing for and entering and living in retirement. Like, do we still need life insurance? So let's jump into this. Any awareness month is an opportunity to get more of the word out to people about that particular topic, and it's an important time for you to consider the role that life insurance plays in your financial security, especially as we enter retirement. Sometimes people are overinsured, underinsured, or they're just not using life insurance um, the right way for the right goals and the right strategy. So, types of insurance. Life insurance generally falls into two different categories: term life insurance and permanent life insurance. And then within these categories, there are several iterations tailored to those different financial goals and different situations. So the first type is term insurance, and it's the simplest and most affordable, straightforward type of life insurance. It covers you and your family for a period of time, let's say 10, 20, or 30 years. And if you pass away during the term, your beneficiaries receive the death benefit. If you outlive the term, the coverage ends and there's no payout. Sometimes you can get life insurance through an employer at pretty affordable fees. My mom was a teacher. She had a small, like $5,000 Massachusetts Teachers Association life insurance. So yeah, basic term insurance. Affordable premiums are some of the benefits and characteristics. The term policies generally have lower premiums than permanent because they only provide that coverage for a set period of time. And then it's really just pure protection. So they're designed purely for life insurance protection without any investment or cash accumulation features. Okay, so it's just protection. And, they say that it's a temporary need. So, if you only need coverage for a specific time period, like let's say until your mortgage is paid off, because if you were to pass, you'd want to make sure that your spouse or partner had the funds to cover the mortgage, or if your children are financially dependent upon you. And so oftentimes people really don't think about, okay, well, I'm earning an income. If I were to pass and that income goes away, what happens to my children? And there are very affordable ways to get some term insurance to at least cover that particular need. And then, of course, the second type is permanent life insurance. It provides coverage for your entire life as long as you pay the premiums, of course. And in addition to the death benefit, these policies include a cash value component that will grow over time and can be assessed or accessed, excuse me, while you're alive. Okay, so it's not just like a death benefit, right? It's going to give you um, access to this cash value while you're living, and that could be for different purposes. And there's different types of permanent life insurance, so that makes it a little more complex. And they offer different levels of benefit and flexibility. So let's talk about the different types of permanent life insurance. One is whole life insurance, and that's really the most straightforward type of permanent insurance. It offers a guaranteed death benefit, fixed premiums, and a guaranteed rate of return on the cash value portion. So, fixed premiums are premiums that remain level throughout the life of the policy. Guaranteed cash value is the cash value grows at a guaranteed rate, providing a predictable, stable return. And then some whole life policies actually pay dividends, which can be used to reduce your premiums, increase the death benefit, or can accumulate as cash. And then, second type, in addition to whole life insurance, is universal life. Universal life offers a little bit more flexibility than whole life insurance, and it allows you to adjust your premium payments and death benefit within certain limits based on your needs and your financial situation. So you can increase, decrease, or skip premiums subject to the policy guidelines as long as the cash value can cover the cost of the insurance. And you can change the death benefit over time as your needs change, and the cash value grows based on interest rates set by the insurer, which can fluctuate. So that was whole life and in universal life. The third one I want to talk about is index universal life, or IUL. And this is a type of universal life insurance that offers the potential for higher cash value accumulation or growth by linking your policy's cash value to the performance of a stock market index, such as the S&P 500. So it's kind of a hybrid. It is an insurance product, but it's hybrid because it's linked to the growth of a stock market index. However, the policy doesn't directly invest in the stock market. So let's talk about index linked growth. It grows based on the performance of that market index, as I said, providing an opportunity for higher returns than a traditional policy. Downside protection. IUL policies often have a floor that protects you from losing money in a downturn, typically 0%, while still allowing for growth in positive market years. Also, one of the real values of this policy is tax deferred growth. So the cash value grows tax deferred, and you can access it through loans or withdrawals, often tax free, as long as the policy is structured properly. So, oftentimes, it could be used as a tax planning strategy for people who are maxing out their 401k up to their employer match. It could be a tax deferred way to invest and save for retirement and for life insurance. So let's talk a little bit about the benefits of an IUL. Um, Potential for higher returns because the cash value is linked to that index. It has the potential to grow faster and more consistently than traditional life insurance. And, it can be an attractive feature for retirees looking for supplemental income or a financial cushion. Okay. Number two is protection from market losses. Like I said, downside protection features such as 0%, meaning your cash value won't decrease to poor market performance, even if the market falls. So people like the security of that. If you're taking like a safety first approach to your financial life and your retirement, it might be something to consider. Tax advantage growth because it grows tax deferred. Um, you know, can potentially be beneficial in retirement when you want to minimize taxes on your withdrawals. So it would not impact, it wouldn't further increase the tax burden that you have on those tax deferred accounts. You're just going to pay the tax on that, but you wouldn't pay the tax on this. Would not affect your Social Security, provisional income. So lots of benefits. Flexible premiums and a death benefit, like other universal policies. Index universal life policies allow you to adjust your premiums and your death benefit, giving you control over how much you want to invest and how much you want to protect. And then I mentioned supplemental retirement income, and this is the fifth benefit of an IUL. The cash value in an IUL policy can be accessed tax free for loans or withdrawals. So instead of taking money from a bank, you could borrow money from yourself. So let's say, this isn't something for you. Like you determine you're 60, 65, whatever, and you're like, no, this isn't something that's going to work for me. Maybe you have some younger children who could benefit from such a product. It might be something that you want to talk to them about as a potential strategy to consider when they're considering their financial strategy. Um, the supplemental retirement income could be a potentially really good benefit because you're going to get that income without triggering any tax consequences. And then I do want to mention a sixth potential benefit for you is adding a long term care rider. So many of us are very concerned about long term care. Will there be a bed in a facility for us? Will we be aging in place? Will we need long term care support in our home? So long term care rider might be something you're interested in, and it is one of the powerful features of an IUL. It allows you to use part of your death benefit to cover long term care costs, such as nursing home care, in home care, or assisted living. If you become chronically ill or unable to perform those activities of daily living, also known as ADLs. And this can be particularly beneficial for retirees who want to ensure that they have coverage for potential healthcare costs in later years without purchasing a separate long term care policy. So, this might be a more financially prudent way to get that long term care coverage. But again, you would have to go and talk with a retirement slash insurance expert to say, okay, if I did an IUL with a long term care rider, how does that compare to just a long term care policy? So you'd want to do that side by side comparison. The benefits of the long term care rider is cost effective protection, right? Instead of buying that standalone policy, adding a rider can provide similar coverage and could keep costs more manageable. There's a dual benefit. If you need long term care, the rider provides financial support without depleting your savings. If you don't use the LTC benefit, your beneficiaries still receive the full death benefit. And then tax free access funds used from the death benefit for long term care expenses are generally tax free, providing a tax efficient way to handle healthcare costs. So by adding an LTC rider to an IUL policy, you really can secure potential long-term care protection while benefiting from that market-linked growth, flexible premiums, and death benefit options. And so this makes IUL a versatile tool in retirement planning. Let me touch upon some other types of life insurance. There's variable universal life, VUL. This policy combines life insurance with investment options also. You can invest the cash value in a variety of sub accounts, similar to things like mutual funds, offering potentially higher returns, but also higher risk, as there's no floor in a VUL to protect against market losses like there would be in an IUL. And then there's guaranteed universal life, which is GUL. Because we don't have enough types, we need to have more types here, but GUL offers lifetime coverage at a lower cost than whole life or IUL, but without the cash value accumulation. And it provides a guaranteed death benefit as long as you pay your premiums. So, when deciding which type of life insurance is right for you, especially in retirement, it's really important to look at your financial goals, risk tolerance, and your beneficiaries. Like, who are they? What are their financial needs? when something happens to you. And also, you have to look at your time horizon. So, there is a time horizon for these cash value life insurance policies. You need some time to build up the value in them in order to access the benefit of them. For some, the affordability and simplicity of term life may be sufficient. You go online. There's lots of different companies. I know one that's targeted for moms called Jenny Life. For others, the cash value accumulation and flexibility of permanent policies, particularly the IUL, can provide valuable parts of an overall retirement plan, right? So it's not just that term policy. You're going to be looking at cash value accumulation or index universal life policies as part of a retirement plan, tax plan, legacy plan. Like it's kind of all intertwined, right? It's not just a standalone, just cover me for a short term, you know, death benefit, basically. Um, I want to give you another bonus tip, and it's something a lot of people may not have heard about, but it's using life insurance in conjunction with a Roth conversion. Okay, so you may or may not know, but you could take monies in a 401k and convert them to a Roth IRA. Now, in that conversion process, you have to pay the taxes up front. So basically, you're converting because you believe taxes are going to be higher in the future for you. And rather than pay the taxes down the road in retirement, which can impact Social Security, which can impact the cost of your Medicare, you want to pay those taxes now and do some Roth conversions before that point in time. Well, when you do that Roth conversion, you pay the tax up front. So, one strategic use of life insurance in retirement planning is pairing it with a Roth IRA conversion. So, as I said, a Roth conversion allows you to convert your traditional IRA or 401k into a Roth where your future withdrawals are tax free, which is really nice to have that tax diversification so that you're not going to have that huge tax bill in retirement and potentially trigger Medicare surcharges called the Income Related Monthly Adjustment Amount or IRMA or impact your Social Security. Um, but that conversion triggers that immediate tax liability, as I said, which, could be significant. And you have to weigh that upfront cost versus, the forward future benefit, which a tax planning specialist, which I have access to, and I can connect you to those people. But you want to talk to them and say, okay, number one, does a Roth conversion benefit me? When, how often do I do them? And then number two, what strategies could I use to pay that initial upfront tax that I have to pay on that conversion? Well, there's a way that life insurance could help. And a lot of people, a lot of advisors, they don't really get into this because retirement really isn't their specialty, or they're just investment advisors and they really don't know insurance. So, my suggestion is to work with a retirement advisor planner who's investment licensed, insurance licensed, and knows taxes, because then they can look at your whole picture and give you some of these unique strategies you might not have thought about. So let's talk about covering tax liabilities with life insurance. The tax bill from a Roth conversion can be steep in some cases, especially if you have a high income year or convert a large amount. A permanent life insurance policy like an IUL can help pay for these taxes. You could use the policy's cash value or death benefit to offset the cost of the taxes, ensuring the conversion doesn't diminish your retirement funds. Okay. Number two is leaving a tax free legacy. Roth IRAs allow you to pass money tax free to your heirs, which is really important, and life insurance can enhance this benefit. The death benefit from a life insurance policy is also tax free to your beneficiaries, meaning you can use life insurance to supplement the wealth you transfer to your heirs, creating a more significant tax free legacy. And three, combining income and legacy planning. While the Roth conversion reduces future tax liabilities on your retirement income, life insurance can act as a tax free legacy vehicle. The combination of these strategies allows you to manage both your income needs and your desire to leave a financial legacy in a tax efficient manner. I will also say that One of the things I hear people say is, I'd like to leave my kids a legacy, but I kind of would like to spend my nest egg also. Life insurance is a way to spend your kids' inheritance and leave an inheritance also. You just have to determine at what cost and in what structure that looks like, and if it fits within your overall strategy, your wishes, and your budget. But by leveraging both life insurance and a Roth conversion, you could better manage your tax exposure in retirement and ensure your loved ones receive the maximum benefit from your estate. So you're kind of killing a bunch of birds with one stone if you consider an IUL for that Roth conversion and paying that upfront tax. It's definitely an interesting way to do it. So I have a conclusion here that I wanted to talk about. Let me just find it because you know what? At this age, I need my notes. Um, anyway, if you have questions about life insurance and retirement planning and tax planning, and you want to learn more about this, definitely reach out to me, Lynn T at herretirement.com. I do have a master course where I have 8 modules on various retirement planning topics. And one of the topics is, or one of the modules is life insurance and healthcare. So you could actually purchase that module separately. You can purchase the whole master course for $297, or you can purchase access to just that module. It's like $37, and it's about an hour long. And I go into much more depth on life insurance, long term care, and healthcare expenses and strategies. So you could go check that out at herretirement.com. And then again, definitely reach out to me if you have questions. And it's really important to be sure to work again with a retirement advisor or a planner, whatever you want to call it. There's so many different names for these people in the industry, but that is insurance licensed, has worked with insurance, index universal life, term life, understands long-term care insurance, can integrate all of that into your overall retirement plan, and understands the tax implications because many CPAs really look at the past. They're reacting, they're completing your tax returns, but they don't do a lot of retirement tax planning. So you want to find someone that is knowledgeable about insurance, investments, and tax planning because they all have to work together to improve your retirement outcome. So again, reach out to me, Lynn T at herretirement.com, if you have any questions about insurance. And, one of the things people do look at is, I have a life insurance policy, but I have a good sized nest egg. And do I really need to keep paying for that policy? Well, it depends upon why that policy was started in the first place and what place does it play in your retirement plan. And oftentimes, when you meet with a retirement planner, they look at that and they say, you know what? This policy really isn't doing anything. It's really, if the expense might not be worth it, let's just let it go. But in other cases, it might be, you know what, this is a great policy. It's part of your overall strategy, and I think it's important for you to keep it. So a lot goes into it, some analysis, looking at your overall plan, and making the best, most informed decision. Because I believe when you know more, you can have more and you can live more. And guess what? You can leave more also if that is an important part of your legacy, leaving some, as my mother used to say, some moolah. If that's important, then life insurance may be an important strategy for you in your retirement. So here's to knowing more, having more, living more, and leaving more, and getting her done. Thanks for watching today.